Subscribe to my channel Report Stock.
Welcome to the Deep Dive. We're your shortcut to getting really well informed on complex topics. Today, we're really digging into the farm equipment sector. There's been a flurry of financial reports, and we want to unpack them. We'll focus heavily on Deere & Company's latest numbers. That's their Q3 for fiscal 2025. But then we'll also zoom out a bit, look at competitors like AGCO, CNH Industrial, maybe even Lindsay Corporation to get the bigger picture. Our mission really is to pull out the most important bits from these dense financial reports, give you the key takeaways without you having to read them all yourself. We'll look at the numbers, sure, but also what's driving them, how these companies are navigating things right now.
Yeah.
Okay, let's unpack this.
Absolutely. And, these reports, they're more than just spreadsheets. They really give us a window into the health of these massive companies. But also, they kind of act as signals for broader economic trends, especially in, agriculture and construction, obviously. So yeah, we need to go beyond just the headlines, look at the specific figures, the trends, and see what story they're really telling, maybe even where the market's heading.
Exactly. So let's kick off with Deere. Their third fiscal quarter just ended July 27th. Now, the headline earnings per share came in at $4.75. And that actually beat the Zacks consensus estimate. That's the average analyst forecast, right? Which was $4.62.
Right. So on the surface, maybe sounds okay, better than expected.
But, and this is the really crucial part, that $4.75, while beating the estimate, is still down 24% from the same quarter last year.
A 24% drop. That's significant.
Yeah, a big drop. And the main reason they cited, lower shipment volumes. They're just not selling as much equipment. Okay, let's talk sales then. Top line revenue. Net sales from their equipment operations, tractors, construction gear, turf stuff, that was $10.36 billion, down 9% year over year. But again, slightly better than the Zacks estimate of $10.26 billion.
So another beat, but still down.
Exactly. And if you add in their financial services and other bits, total net sales hit $12.02 billion. That's down 8.6% compared to a year ago.
So what's really fascinating here, I think, is how you can have these slight beats on the sales estimates, but they're masking some pretty serious pressure on the actual profit.
Yeah.
If you dig into the profit numbers, well, their cost of sales went down a bit, about 3.5% to $7.57 billion.
Okay.
But because those sales volumes slumped, their total gross profit, basically what's left after making the stuff that fell hard, down 21.2% year over year, landing at $2.79 billion.
Wow.
Yeah. And while their selling and admin costs dipped a little too, the really key number, total operating profit before interest and taxes, that slumped massively, down 31.7% year over year, just $1.57 billion.
Over 30% drop in operating profit.
Exactly. It really shows the squeeze they're under, lower volumes, maybe pricing pressures. It hits the bottom line hard.
Those overall profit drops are definitely stark. But like you said, to really get what's going on at a company like Deere, you got to peel back the layers, right? Look at the individual business segments.
Absolutely. That's where the nuances are. A big company like this isn't monolithic. Different divisions face different pressures, different market dynamics.
Okay, so let's start with their big one. Production and precision agriculture. This is the huge tractors, the combines, big iron.
Right, the core ag equipment.
Sales there. Down 16% year over year. $4.27 billion. That actually missed their own estimates slightly.
Okay, so a miss there.
And the operating profit for that segment took an even bigger hit, down a massive 50% year over year, only $580 million.
50%. Ouch.
Yeah. And the main drivers they mentioned were those lower shipment volumes we talked about, but also something called unfavorable price realization.
Right. An unfavorable price realization basically means they're not getting the prices they expected, or perhaps what they got before. It could mean discounting or just less ability to pass on costs. Either way, it eats directly into profit margins, especially on that expensive equipment.
Makes sense. And it suggests maybe the larger farms are pulling back on those big investments.
Could be. Definitely points to some caution in this.
Okay, now interestingly, the small agriculture and turf segment, think compact tractors, lawnmowers, that kind of thing. Sales there fell only 1% to $3.03 billion. But here's the twist. That was actually higher than projected sales.
Oh, interesting. So better than expected there.
Yeah. They said lower shipment volumes were offset by favorable currency translation and, get this, favorable price realization.
So the opposite of the big ag segment, they were able to hold or even improve pricing here.
Seems like it. And currency helped too, meaning international sales looked better when converted back to dollars.
Right.
So despite higher warranty costs, the operating profit for this segment only fell 2% to $485 million. and that significantly beat the estimate.
So a much more resilient picture in the smaller equipment and consumer-facing turf market. That's quite a contrast.
Definitely. Okay, next segment, construction and forestry. Sales were $3.06 billion, down 5% year over year, missed estimates.
Okay, another miss.
And operating profit here decreased substantially too, down 47% to $237 million. Also missed estimates.
47%. Wow. So similar profit pressure to the big ag stuff.
Yeah. Again, unfavorable price realization was a factor, but they also specifically mentioned higher production costs because of increased tariffs.
Ah, tariffs. Right. That's that external factor hitting the cost side.
Exactly. They said a favorable product mix helped a bit, but clearly not enough to offset the tariffs and pricing issues.
It really shows how those trade policies can directly impact the bottom line, doesn't it? And it suggests the construction market is also seeing a slowdown, not just ag.
Seems that way. Okay, finally, their financial services arm. This is the part that finances the equipment purchases.
Right. Dare Capital.
Revenues, they were $1.42 billion, down 4% year over year. Okay, not great. But the net income, $205 million. That's actually up quite a bit from $153 million last year.
Up. How did they manage that when equipment sales are down?
Good question. They said it was primarily due to a lower provision for credit losses.
Okay, explain that.
So the provision for credit losses is basically money they set aside because they expect some customers might default on their loans.
Got it. Like a rainy day fund for bad loans.
Exactly. A lower provision means they're expecting fewer defaults than they previously anticipated, or fewer than last year. So less money set aside means more flows to the bottom line as reported income.
Ah, okay. So even though they might be financing fewer new machines, the existing loan book looks healthier than expected. Customers are still paying their bills.
That seems to be the implication. A sort of nuanced positive sign within a generally tough quarter for the equipment side.
It really is. It highlights how diverse factors shape the results. You've got volumes, pricing, currency, tariffs, even loan loss provisions all playing a part. You can't just look at one number.
Absolutely. So summing up the segments, definitely a mixed bag, but the overall trend on the equipment side is clearly down, especially profitability. What about their overall financial health? Cash, debt, and crucially, what are they forecasting?
Good question. Let's look at the balance sheet and outlook.
Okay, so cash and cash equivalents actually went up. They ended the quarter with $8.58 billion, up from $7.32 billion at the end of last fiscal year.
Okay, more cash on hand.
But cash flow from operations over the first 9 months of their fiscal year was $3.46 billion. That's down from $4.14 billion in the same period last year.
Right, so less cash being generated by the day-to-day business, even if the pile is bigger for now.
Exactly. And their long-term debt ticked up slightly to $44.43 billion.
Okay. Manageable, given their size, but worth watching.
Now, the guidance. What they expect for the full fiscal year 2025, they've narrowed their net income forecast.
Narrowed how? Up or down?
They kept the bottom end the same, but lowered the top end. So the previous range was $4.75 to $5.5 billion. The new range is $4.75 to $5.25 billion.
So basically acknowledging things might not be quite as good as they hoped at the higher end, a more cautious stance.
Precisely. And they gave specific sales forecasts for the segments. Production and precision ag, down 15-20% for the year.
Wow.
Small ag and turf, down 10%. Construction and forestry, down 10-15%.
So declines projected across all major equipment segments.
Yep. The only relative bright spot in the forecast is financial services net income, expected around $770 million, holding fairly steady.
This revised guidance, bringing down the top end and projecting these double-digit declines in equipment sales? Well, it really signals that management sees these headwinds continuing, doesn't it? They're not expecting a quick turnaround in demand in the next quarter or so. It does raise that question. Is this just a pause? Or something more sustained in the ag and construction markets?
That's the multi-billion-dollar question, isn't it? So that's Deere in detail. But now the big question. Is this just a Deere story, or is everyone in the pool feeling the water get colder?
Right. Context is key. Let's look at some competitors.
Okay, first, AGCO Corporation, another big global player. Their Q2 2025 results, adjusted earnings per share, were $1.35.
Okay. And how does that compare?
Down sharply from $2.53 last year. But like Deere on some metrics, it actually beat the analyst estimate, which was $1.06.
So better than feared, but still a big drop.
Exactly. And their net sales, $2.36 billion, down almost 19% year over year, but again, slightly beat the estimate.
Seeing a pattern here, beat estimates, but significant year-over-year declines.
Seems to be the theme. Now, CNH Industrial, their Q2 2025 adjusted EPS was 17 cents, down from 38 cents last year, but surpassed the estimate of 16 cents.
Okay, same story again.
And net sales for CNH, $4.71 billion, down nearly 14% from a year ago. Topped their estimate, though. They specifically noted that sales from their industrial activities, the equipment part, were down 16%, and they explicitly blamed lower industry demand.
Right. So AGCO and CNH, very similar picture to Deere, fundamentally. Widespread sales and profit drops compared to last year, even if they managed to clear the lowered bar of analyst expectations. It really reinforces that this isn't just a Deere issue. It looks like a broader sector slowdown driven by that weaker demand.
Oh, wait, there's an interesting outlier here. Lindsay Corporation.
Ah, Lindsay. Yeah, they're a bit different. What did their numbers show?
Their adjusted EPS was $1.78 for their Q3 fiscal 2025. That beat the estimate of $1.36. It was slightly down from $1.85 last year, so a small dip.
Okay, a slight dip, but still beat estimates.
But here's the key difference. Sales. Lindsay generated $169.5 million in sales. That's up 22% from the same quarter last year. And it beat estimates too.
Up to 22%. Wow. That completely bucks the trend we saw with the big three.
Right. Quite the contrast.
And Lindsay, their focus is heavily on irrigation systems, isn't it?
Exactly. Center pivots, irrigation technology.
Well, that makes sense then. It highlights how different niches within the broader farm equipment umbrella can behave very differently. While farmers might be delaying buying a huge new tractor or combine due to economic uncertainty or lower commodity prices, investing in efficient irrigation might still be a priority, especially with water scarcity and climate concerns.
Good point. Demand for water efficiency could be more resilient right now.
Yeah, it just shows that while the tide might be going out for heavy machinery, some boats, like Lindsay's perhaps, are in a different current. Individual strategies and market niches really matter.
Okay, so let's try and bring this all together for you listening. What does this all really mean if you're tracking this industry?
We've definitely seen a general softening of demand, lower shipment volumes hitting profits pretty hard across most of the big farm equipment players, Deere, AGCO, CNH.
That seems clear.
But it's not uniform. We saw Lindsay showing actual growth, likely due to their irrigation focus. And even within Deere, different segments had very different results. Small ag holding up better than large ag or construction.
Exactly. And we saw that recurring theme of companies beating analyst estimates on maybe revenue or EPS, but still reporting pretty stark declines compared to the previous year, which really underscores why you need to look at both figures, right? The estimate beat tells you about recent expectations, but the year-over-year change tells you about the underlying business momentum.
Absolutely. You need the full picture. And digging into those details, price realization, currency impacts, tariffs, even those credit loss provisions, they all layer together to create that final number. It's complex. Which brings us back to that core question. How much of this slowdown is just the normal up and down cycle of these industries? Agriculture and construction are famously cyclical.
Right. They have booms and busts.
Or is there something more fundamental shifting? A longer-term change in farmer economics, construction activity, maybe technology adoption rates. It's hard to say definitively from 1 or 2 quarters.
That's a really powerful question to keep in mind as we watch this unfold. Well, thank you for joining us on this deep dive into the farm equipment sector's financials. We hope breaking down these numbers helps you get a clearer, more nuanced understanding than just reading the headlines.
Definitely. And maybe one final thought to leave you with. Think about how these individual company reports, when you piece them together like we just did, start to paint a picture of these broader market dynamics. Dynamics that might be hidden if you only looked at one company or only at the surface numbers. And then consider how might these current financial shifts, the pressure on profits, the cautious outlook, how might that affect things like R&D spending, future innovation, or investment priorities within the sector down the road?
That's a great point. Lots to think about. Keep exploring, keep observing how these trends develop in the coming quarters. Thanks for listening.
Subscribe to my channel Report Stock.